Be the insight you need. I'm Olivia. Latest data shows that the U.S. job market and manufacturing activity have shown signs of cooling down. At the same time, more uncertainties brought by the ongoing banking crisis are said to be increasing the risk of recession in the U.S. economy. According to data from the U.S. Department of Labor, the number of job vacancies in the U.S. in February was 9.9 million. It's the first time the data has fallen below 10 million since May 2021, showing that the labor market that once supported the economy has begun to slow down. The cooling signaled that the Federal Reserve's efforts to reduce inflation levels could start to have an impact on the labor market. At the same time, data released by the Institute for Supply Management showed that the U.S. Manufacturing Purchasing Managers Index, or PMI, recorded a 46.3 value in March, the lowest since May 2020. It was also the fifth consecutive month that the indicator was below 50, indicating that the industry is still in contraction. Analysts pointed out that the latest PMI report is in line with the previous inflation data released by the United States, both pointing to the possibility of renewed inflation. The continuous contraction of the PMI index also implies that the U.S. is under greater recession pressure. In addition, the successive closures of Silicon Valley Bank and Signature Bank triggered turmoil in the banking industry. At the end of March, the Federal Reserve announced that it would raise the target range of the federal funds rate by 25 basis points to between 4.75% and 5%, the highest level since September 2007. Since March last year, the Federal Reserve has raised interest rates 9 times in a row, with a cumulative rate hike of 475 basis points. Some policymakers have said tighter financial policy could weigh on economic activities. Take the U.S. real estate market as an example. According to the survey results of the housing analysis company Posonomics, the average respondent expects house prices in the United States to fall by 2% this year, which means that the value of the U.S. housing market will drop from $47.9 trillion at the end of 2022 to $46.9 trillion. The analysis pointed out that with the rapid rise of interest rates, the cost of financing home purchases has also risen sharply, coupled with the slowdown in rental growth, resulting in a decline in apartment sales. The unrest in the banking sector is also making it more difficult to buy a home, with a growing number of banks reducing lending or only lending at high interest rates. And recently, a number of U.S. financial institutions and economists have issued forecasts that the U.S. economy will fall into recession. In March this year, Goldman Sachs raised the probability of a U.S. recession to 35%, arguing that the country's banking crisis has led to increased uncertainty. Standard Chartered Bank predicts that within the next 12 months, the probability of the U.S. economy entering a recession will reach 80%. And according to Bloomberg, after the outbreak of the Silicon Valley Bank crisis in the United States, global investors have become extremely sensitive to potential financial pressure.